Imagine putting all your money into a single investment. What happens if that investment fails? You lose everything. That's a scary thought, right? This is where diversification comes in. Diversification is like creating a safety net for your investments. Instead of relying on one single asset, you spread your money across different asset classes. Think of it like building a house with multiple strong pillars. Each asset class represents a pillar. You want a mix of stocks, bonds, real estate, and maybe even commodities. This way, if one asset class stumbles, the others can help support your portfolio. Remember, diversification is about managing risk. It won't guarantee profits, but it can help protect you from big losses and keep you on track to reach your financial goals. Let's say you invest all your money in a single tech stock. It might seem like a good idea at first, especially if that company is performing well and showing promise. The tech industry is exciting, but it can also be unpredictable. Rapid advancements and fierce competition mean that today's leader can quickly become tomorrow's laggard. What if a new competitor emerges or a major technological shift occurs? These changes can drastically affect the stock's performance. That stock could plummet, taking your savings with it. Now imagine you diversified. Instead of putting all your eggs in one basket, you spread your investments across different sectors. You invested in that same tech stock, but you also bought shares in a healthcare company, a consumer goods giant, and a real estate investment trust, or REIT. By doing this, you are not solely dependent on the tech industry. Even if the tech stock underperforms, your other investments can cushion the blow. The healthcare company might thrive due to an aging population and increased demand for medical services. The consumer goods giant could benefit from steady demand for everyday products, ensuring a stable revenue stream. The REIT might provide rental income and appreciation, giving you a steady return on your investment. Diversification helps you weather the storms of the market. It's a strategy that spreads risk and increases the likelihood that some of your investments will perform well, even when others don't. By having a mix of investments, you are better positioned to handle market volatility and unexpected downturns. It's about spreading risk and increasing the likelihood that some of your investments will perform well, even when others don't. This way, you can build a more resilient financial future. Think of asset classes as the main ingredients in your investment recipe. Just like in cooking, the right mix of ingredients can create a balanced and satisfying dish. Each asset class has unique characteristics and plays a specific role in your portfolio. Understanding these roles can help you make informed decisions. Stocks represent ownership in a company. When you buy a stock, you become a part owner of that business. Stocks offer the potential for high returns, but they also carry higher risk. The value of stocks can fluctuate widely in the short term. Bonds are essentially loans you make to governments or corporations. In return, you receive periodic interest payments. Bonds typically offer lower returns than stocks but are generally less risky. They can provide a steady income stream and help preserve capital. Real estate includes physical property like houses and apartments. Investing in real estate can diversify your portfolio. Real estate can provide rental income and potential appreciation. It can also act as a hedge against inflation. Commodities are raw materials like gold, oil, and agricultural products. These tangible assets can be traded on various markets. Commodities can act as a hedge against inflation. Their prices often move in the opposite direction of stocks and bonds. Alternative investments are a broad category that includes things like private equity, hedge funds, and cryptocurrencies. These can add another layer of diversification. Alternatives can be very risky, but also offer the potential for outsized returns. They are often less liquid and more complex than traditional investments. Understanding the basics of each asset class is crucial for building a diversified portfolio that aligns with your financial goals and risk tolerance. A well-diversified portfolio can help manage risk and improve the chances of achieving your long-term financial objectives. When you buy a stock, you're buying a small piece of ownership in a company. You become a shareholder and your investment grows if the company performs well and its stock price increases. Stocks are often categorized by market capitalization, which is the total value of a company's outstanding shares. Large-cap stocks are stocks of large, established companies, typically less volatile but offer slower growth potential. Mid-cap stocks are stocks of medium-sized companies. They offer a balance of growth potential and stability. Small-cap stocks are stocks of smaller, newer companies. They have higher growth potential but also higher risk. You can further diversify within stocks by investing in different sectors such as technology, healthcare, energy, and consumer goods. Bonds are less glamorous than stocks, but they play a vital role in a diversified portfolio. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to pay you regular interest payments and return your principal when the bond matures. Bonds are generally considered less risky than stocks because they offer more predictable returns. However, bond prices can fluctuate based on interest rates and the issuer's creditworthiness. Here are the main types of bonds: government bonds, issued by governments. Considered the safest type of bond, corporate bonds, issued by corporations, offer higher potential returns than government bonds but carry more risk. Municipal bonds issued by state and local governments. Interest income is often tax-free, making them attractive to certain investors. Real estate has long been a popular investment option. It offers several potential benefits, including rental income. If you own rental properties, you can generate regular cash flow from rent payments. Appreciation. Real estate values tend to increase over time, although this is not guaranteed. Tax advantages. Depending on your location and tax laws, you may be eligible for tax deductions related to real estate investing. You can invest in real estate directly by purchasing properties or indirectly through REITs. REITs are companies that own and manage income-producing real estate such as shopping malls, office buildings, and apartments. Commodities and alternative investments can add another layer of diversification to your portfolio. Commodities are raw materials like gold, often seen as a safe haven asset during times of economic uncertainty. Oil, a crucial energy source that can fluctuate significantly in price. Agricultural products include things like corn, wheat, and soybeans, which are essential food sources. Alternative investments encompass a wide range of assets, including private equity, investing in privately held companies. Hedge funds, pooled investment funds that use various strategies to generate returns. Cryptocurrencies, digital currencies like Bitcoin and Ethereum. These asset classes can be highly volatile, but they often have low correlations with traditional stocks and bonds, meaning their prices tend to move independently. This can make them valuable diversification tools, but it's essential to understand the risks involved. Asset allocation is the process of deciding how to divide your investment portfolio among different asset classes. It's like creating a personalized recipe for your financial future. Your ideal asset allocation depends on several factors, including financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Risk tolerance. How comfortable are you with the ups and downs of the market? Time horizon. How long do you plan to invest your money? For example, a young investor with a long-time horizon and a high risk tolerance might choose an aggressive asset allocation with a higher percentage of stocks. A retiree seeking income and capital preservation might opt for a more conservative allocation with a larger portion in bonds. Even a well-diversified portfolio requires regular maintenance. This is because the financial markets are always in flux, and what might be a balanced portfolio today could look very different in a few months. Over time, as some investments perform better than others, your asset allocation can drift from your original plan. This drift can expose you to more risk than you initially intended, or reduce your potential returns. Rebalancing involves selling some of your winning investments and buying more of the underperforming ones to bring your portfolio back into alignment with your target asset allocation. This process ensures that you are not overly reliant on any single investment. For example, let's say you started with a portfolio of 60% stocks and 40% bonds. This mix was chosen based on your risk tolerance and investment goals. After a strong year for stocks, your portfolio might be 70% stocks and 30% bonds. While this might seem like a good thing, it actually means your portfolio is now riskier than you intended. Rebalancing would involve selling some stocks and buying more bonds. This action helps to bring your portfolio back to its original risk level. Rebalancing helps you maintain your desired level of risk and return, and prevents you from becoming overexposed to any single asset class. It's a crucial step in managing your investments effectively. It's generally recommended to rebalance your portfolio at least once a year, but you might need to do it more frequently if your investment goals or risk tolerance changes. Regularly reviewing and adjusting your portfolio ensures that it continues to meet your financial objectives.